Hey everyone, BigBear.ai and SoundHound AI have seen their stock prices explode this week on the back of rising demand for artificial intelligence. So I thought it'd be an interesting comparison to answer which one I thought was the better stock to buy right now in comparing these two across several critical financial metrics. So let's jump right in. Let's take a look at these two excellent AI innovative companies.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Like I mentioned, their stock prices, you can see here, have exploded. They were sharing a similar trend line here with SoundHound AI and Big Bear, trading at around the same valuation here before SoundHound AI really exploded much higher than BigBear.ai. SoundHound AI up to $7 a share, Big Bear AI $3.32 per share. SoundHound AI, of course, getting also an additional benefit because NVIDIA announced an investment in a SoundHound AI that created further buzz for SoundHound AI. But let's go further here. Let's look at revenue growth comparison between these two and a similar trend line with SoundHound AI demonstrating better revenue growth, especially in the latest quarter, where it increased revenue by 18.61%, whereas BigBear.ai decreased 16.39%. So SoundHound growing better than BigBear.ai. Now, the next metric I'm going to compare them on is cash flow from operations to sales, but I want you to understand why this metric is important first. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you've got an understanding, you can see the difference between these two. Negative 18% for Big Bear AI, negative 195% for SoundHound AI, but SoundHound making better progress towards profitability here. The next thing I want you to understand is average diluted shares outstanding. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. Okay, so now that you've got a grasp of this concept, you can see SoundHound is diluting shareholders much more aggressively than BigBear, although they are both diluting shareholders, up from 75 million to 242 million for SoundHound, and for BigBear.ai from around 110 million to 157 million. And finally, I'm going to compare these two on the forward price to sales ratio, and here's why that's important. The price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion, and the sales for the previous 12 months were $185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for $465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. Okay, so looking at this metric, you can see SoundHound AI is more than 6 times as expensive as BigBear.ai, trading at a forward price to sales of 18.47 compared to BigBear.ai trading at a forward price to sales of 2.73. Now, given the metrics that we've looked at so far and the wide disparity between these two, there's a few characteristics to consider here, namely that SoundHound AI is improving quicker than BigBear.ai, although BigBear.ai is losing less money on the bottom line compared to SoundHound AI. All else being equal, if I was to pick one of these two AI stocks to buy today, I would pick SoundHound AI would be my choice of better AI stock to buy. Although I wouldn't be surprised if this changes around in the coming weeks and months because there's going to be so much more information coming out from these two companies over the next months. So stay tuned and wait for an update to this recommendation coming soon. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.